Let's start with the outlook. Without making any heroic assumptions, we expect mid-single-digit returns for holders of government bonds over the next year, simply from yields. Better for portfolios holding some credit, and of course better still if economy were to turn down, even if we don't wish for this to happen. Inflation will likely continue to moderate, but at a slower pace, and which combined with looser labor markets will allow central banks to start easing monetary policy in the second half of the year, cutting by at least 100 basis points over the next year. That's assuming no recession, and more if recession were to occur. Risks to this outlook come from geopolitics and to some extent labor markets. Geopolitics, because as attacks on oil tankers in the Red Sea continue, and we deal with continued war waged by Russia, this may at some point lead to higher oil prices. As for labor markets, we are a bit more sanguine about their impact on inflation, believing that it's higher inflation that leads to wage demands and not vice versa. I'd like to end with a few words on US exceptionalism in the context of the strong economic growth that we have seen in the US. Well, it is not so exceptional when you fuel it with deficits of 7% of GDP. What is exceptional is that these deficits were allowed to happen during the economy that's booming with no recession. Yet the spending is unlikely to be pulled back in the election year. Theoretically, fiscal concerns could exacerbate the sell-off, driving term premia higher, but that would be offset, we believe, by a drop in neutral real rates, or R-star, because the stock of debt is likely to weigh on the potential economic growth as more and more revenues will be diverted to servicing debt from discretionary spending. These are longer-term concerns and unlikely to be addressed this year.